Hey everyone, happy Thursday, May 22nd. It's about 10:15 in the morning on the West Coast, and it's time for another market update. Well, the last few weeks, it hasn't been jobs data or inflation data driving the markets. It's been other narratives, things like tariffs. This week, we had a new one. This week, we got the US's credit rating and deficit worry. So, those are the new narratives that the market's latched onto and is driving quite a bit of volatility. So, getting right into it, first one we got was last Friday near the end of the day. Moody's, one of the credit rating agencies that rates countries, just like we have credit scores, countries have credit ratings. They downgrade the United States from AAA, which is our highest. Countries like Australia, Canada, Denmark, Germany have those ratings to an AA1. So it put us second tier basically with Finland and Austria. Reason behind that, we have 37 trillion in debt. They don't like that. Our debt to GDP is really high. So a federal deficit right here as a percentage of GDP is 6.4%. That's the highest out of all these on this list. So Moody's didn't like that. Moody's lowered our credit rating. Markets did not like our credit rating being lowered. And on Monday, when the markets opened up, U.S. Treasury yield spiked, above its 4.4 rate here, went up all the way above 4.6, which is not good for mortgage rates. Without getting into the technicals, all bad stuff for mortgage rates. Was bad for the stock market on Monday as well. One thing to keep in mind though is S&P right here. Here's another one rating. They downgraded us as well. They downgraded us back in 2011. So this has happened before. We've actually been at the second tiered rating all the way back to 2011, and then there's a third one. Fitch, I believe, had downgraded us in August of 2023. So all three bureaus now, or credit country credit reporting agencies, downgraded us to their second level instead of the first level. Markets did not like that. Mortgage rates did not like that. So that was a tough one. Like I said, the next one that came up was deficit worry. So that passed this morning. The new budget passed the House. Now it has to go to the Senate. Basically, a lot of the nonpartisan agencies that look at this stuff are saying it's going to add to our deficit. So our credit rating was just dropped because our deficit is already too high, and it's saying our deficit is going to keep going up and up and up. So that's another thing the markets did not like, and U.S. Treasuries did not like, which negatively affects mortgage rates. So both these were double negative over the last week or so, hitting mortgage rates. So not a good thing, kind of out of our control, not the normal data we're looking at, just things that came up. So it's very important, obviously, that we have as balanced a budget as possible. But again, who knows how that's going to come out of the Senate. Next thing we got, so some actual data. We got April starts and permits, and those were down across the board. So this is a new construction in the month of April. So permits came in at 1.41 million. They were down almost 5% month over month. And keep in mind, permits are our first idea that someone's going to build something new. So that's our first indication we're going to get new inventory, whether it's an apartment or a new single family home. Those are down 5%. Starts were up slightly, but still down year over year. And if you look, all four of these are down quite a bit year over year. Completions down almost 12.5%. Construction, homes in construction process down over 14% year over year. Permits 3.5% almost, and starts getting close to 2%. So not good. For people that are looking for more inventory. We definitely need more inventory. We need more apartments, houses across the country, for the housing shortage, but it is good. It is price supportive. Obviously, the less competition you have as a homeowner, the more house is going to be worse. So, good for current homeowners, not good for people looking for more homes out there to buy. April's existing home sales. So this came out this morning. It actually it's the lowest reading in April since 2009. We never like to hear anything, connected to 2009, but here we are. So again, this is closings on existing homes. It was down about 0.5% month over month. It was supposed to go up close to 3% month over month. We're down over 2% year over year. And like I said, it's the slowest April since 2009. Median home price was up to 414,000. Month over month, that was up 2.7%, and we're up just a little under 2% year over year, the median home prices. So homes are still going up in prices. That's just slowing. Inventory hit 1.45 million units. It's up 9% month over month, 21% year over year. But keep in mind, it's time of year when people do list their homes. So that's pretty, this happens every year where we have a spike in inventory. So that brings us up to 4.4 month supply, where the normal market is 4.6. So we are still below a normal market. And obviously, different pockets, different parts of the country are going to be a little bit different. But nationally, we're still considered, a little bit of a seller's market. So we are getting closer there, but it's still just underneath that normal market, a balanced market of 4.6 months inventory. And then days on inventory actually dropped. Last month, it was at 36 days on average in inventory. In April, it dropped to 29. Last April, it was 26 days. So that's interesting. So things that came on the market went a little quicker. One thing to point out, and this is something just anecdotally talking to people locally, this has happened quite a bit of cancellations rates. People pulling out of contracts in the month of April. That's been correlated to stock market volatility, which makes sense. If someone was going to get their down payment out of stocks, maybe they don't have that anymore, or maybe they just don't want to sell the stocks at that point because they're going to take a big loss. You don't want to sell the low point. So overall, obviously mortgage rates and then all this volatility having to do stocks and 401ks and all that obviously is having a pretty big effect and slowdown on the housing industry. But if rates come down and things settle down, then we have so much pent up demand now that will cause quite a bit of activity, and those on the sideline waiting will probably find themselves viewing, even with lower rates, much higher priced homes, and sellers not willing to work with them. So that's something to keep in mind. Next thing we got. So initial jobless claims came out today. Again, pretty low, 227,000, supposed to be about 230,000. It's been in this range for quite a bit. Like we talked about, this is important because this is one of the first indicators we'll get. A lot of people filing for unemployment means, job markets, weakening means our economy slowing down. Economy slows down, Fed generally will cut rates to stimulate our economy. And that's, what we want with mortgage rates. So where does that leave us? So the average 30-year conventional rate jumped to, I think, 3-month high. The good news is the 3-month low wasn't that much different. We've kind of been in the 6.5 to 7 and an eighth or so for the last 5-6 months, or if not longer. Last week we were at 6.96. So like I said, we did jump up quite a bit with this credit rating first, and then these deficit worries over the last couple of days. So not good news for mortgage rates, heading the wrong direction again. The high over the last year, 52 weeks, was 7.34, so we're still below that. But again, I think the low over that time is about 6.12. So we've kind of been in that, a 1-point range now for over a year. So not good news. Let's hope we get some, better news with the week comes, especially if we can see that deficit number come down in this new budget. So important dates. What do we have coming up? And next Friday, we get PCE inflation. That'll be very important. Week after that, we get it's jobs week. Besides the other jobs reports like ADP, we'll get the BLS jobs report. Then CPI, another inflation report on June 11th. And then on June 18th, the Fed makes their next rate decision. Right now, it's 5% chance. 5% chance they cut. 95% chance they do nothing. They're still waiting. They're kind of stuck in a tough place where they don't know what to do next because they can make a bad decision either way they go. So tough spot to be in. Glad I'm not a Fed member, but let's hope they end up making the right decision, and let's hope for lower mortgage rates. So if anybody needs anything at all, please don't hesitate to reach out. Otherwise, have a great Memorial Day weekend. Thanks, guys.